James was previously on the panel, but we're delighted to welcome him back because he has more than 25 years extensive experience in all forms of equity and hybrid capital raisings and other corporate finance transactions, as well as public and private merger and acquisition deals. He's advised on many corporate transactions, particularly in the healthcare and education sectors, and his experience includes initial public offerings, placements, rights issues, entitlement offers, secondary sales and convertible and corporate bonds offers. His clients include a full spectrum of company issuers, private equity sponsors, institutional investors, and lead managers and underwriters. His mergers and acquisition experience spans private treaty trade sales, sales and acquisitions by private equity sponsors, as well as public M&A transactions and joint ventures. Today, he'll be presenting on the successful approaches to Australia-China investment and M&A in the Australian healthcare industry. So over to you, James. Thank you.
Thank you, Virginia, for the introduction. Today, I want to briefly outline a case study of successful bilateral healthcare transactions between China and Australia, particularly relating to China Grand Pharmaceutical and the investment and licensing deal that's done with ASX-listed Melbourne-based Telix Pharmaceuticals. And I want to talk about why this type of transaction is, in my view, an excellent blueprint to showcase commercial cooperation for mutual benefit. I note that the Telix deal was not China Grand's first in Australia. In 2018, MinterEllison advised CDH Investments and China Grand on their last-minute $1.9 billion joint takeover for ASX-listed Certex Medical. Certex is a global healthcare business at that time listed on the ASX. Its core product is a clinically proven liver cancer radiation therapy called Spheres, which are supplied into more than 40 countries. One of the bidders, CDH Investments, Chinese headquartered international PE firm, manages well in excess of 25 billion US in assets. It's been described in Australian press as the KKR of China. It's invested in 72 countries across the globe, including in the healthcare sector. The other joint bidder was China Grand Pharmaceutical and Healthcare Holdings, which is a diversified global pharmaceutical, principally engaged in R&D sales of pharmaceutical products, medical devices, pharmaceutical and nutritional products. It's listed on the Hong Kong Stock Exchange, capitalisation of about $1. So CDH and China Grand were attracted to Certex because China has one of the highest incidence of liver cancer in the world. The investors were ideally positioned to grow Certex's existing global business and the potential of its core product in China, where Certex was not the product was not currently available. So CDH and then China Grand with it submitted a last-minute offer, trumping a US-based company that had offered 1.5, and CDH and China Grand came over the top at 1.9 billion. The Certex board and our clients conducted mutual due diligence, and ultimately the board and Certex shareholders approved the offer. The joint offer involved a funding structure with debt, equity. It required regulatory approvals, including FIRB clearance, which was given, and US antitrust clearance, which was also given. And the deal was a couple of years ago now, but the deal is now bearing fruit and seen as a very successful acquisition. Certex has now subsequently gained approval for a new drug application filing for its proprietary technology of the Spheres by the National Medical Products Administration of China. And I think what's important to note here is the Certex business has not been just solely repurposed for use in China, but really it's a natural extension or expansion of what was already becoming a global healthcare business by providing it with an opportunity to make a significant inroad into an entirely new and important market in China and a market with unmet need. It does so now with owners with a dedicated investment and strategic intent for developing important medical technologies. So overall, a win-win for everybody. I want to turn now to Telix transaction, which is only lately announced at the end of last year. Telix is a clinical stage biopharmaceutical company. It's focused on the development of diagnostic and therapeutic products using molecularly targeted radiation, or MTR. Telix is headquartered here in Melbourne, but it already has international operations in Belgium, Japan, and the US. It's developing a portfolio of clinical stage oncology products to again address significant unmet medical need, focusing on prostate, kidney, and brain cancer. Telix is also listed on the Australian Securities Exchange. Late last year, we again advised China Grand on making an investment and a strategic license and commercial partnership of about $400 million into Telix. Essentially, Telix has appointed China Grand as its exclusive partner for the Greater China Territory, with exclusive development and commercialisation rights to the portfolio of Telix's MTR products. I note that at the time, Telix's CEO, Dr. Chris Behrenbusch, stated that in furthering Telix's mission to be a leading global oncology company, it very much sees China as an important future market. And Telix was pleased to be working with China Grand to deliver products for cancer patients in China. And the reason I mentioned Certex before in that case study is that Telix, in fact, came out and said, we looked at the successful acquisition of Telix, of Certex, and from that, the Telix board was very confident and of the firm belief that China Grand, as a business partner going forward, possessed both the technical experience, the financial acumen, and execution infrastructure to be an ideal clinical and commercial partner for Telix in China. So building off, seeing other successful deals gave the Telix board a great deal of comfort. From China Grand's perspective, as I said, it has a strong commitment to oncology, including radioactive products. It sees nuclear medicine as the future and has a strategy to build a suite of world-best products with significant potential for Telix's product portfolio to fit in there, including with a significant clinical impact in China. The arrangement is a very long-term partnership, an initial term of at least 10 years from the date that a marketing authorisation is granted in respect of each of Telix's products in China. So the potential to be a very long-term partnership. I mentioned it was a $400 million deal, 35 million in upfront non-refundable payments, 320 million in regulatory and commercial milestone payments, 100 million of those payments earmarked for successful marketing authorisations in China, and nearly $100 million towards clinical costs. And on top of all those milestone payments, royalty payments coming back to Telix on therapeutic product sales in the territory. I also mentioned that China Grand made an equity investment in Telix by way of a private placement of shares in Telix, taking about 8% of the company for $35 million. Just in wrapping up, I want to make some brief observations, just drawing out some themes from those deals around Australian pharma and life science companies that are looking to China and other countries in Asia for investors and partners, and vice versa, those countries coming here to Australia. From my perspective, there are clear opportunities in the Asian region, particularly in China, for Australian pharma and life science companies looking to secure investors for both funding and collaboration partners for research and commercialisation. And on the flip side, Chinese and other regional investors and industry players are very much actively courting Australian companies. This is leading to increasing inbound and outbound investment and M&A activity from the deal experience that we're seeing firsthand. using some other examples of outbound activity from Australia into Asia, there are at the very least 2 ASX listed players with late stage assets or products that have secured both Chinese and Japanese investors or partners. Mesoblast, which has partnerships with China's Tasly Group and also Japan's JCR Pharmaceuticals, and Dendrimer product maker Star Pharma, which has partnerships with diversified Chinese group Shenyang Sky and Latex Company, and also Japan's Okamoto Industries. So regional investors and trade players are clearly attracted to the quality of Australia's scientific research, know-how and potential clinical outcomes. We're seeing these companies receiving Chinese or other regional approaches very regularly. Great interest being shown to secure opportunities to invest or partner technology and products through China's regulatory system pathways. And these are not just for late stage or, for example, phase 3 products. In many cases, they're actually earlier stage products as well. In terms of what we're seeing right now in 2021, deal activity is still continuing. A range of subsectors are featuring, including in relation to larger industry players in hospitals, surgery groups, to more specific players such as regenerative medicines like stem cells. So in conclusion, my view is that, and this harkens back to the comments I made on the earlier panel, for carefully structured cooperative partnerships, joint ventures to develop and enhance technologies, developing them into new and expanded markets, irrespective of where those markets might be, those types of deals are very well positioned for success. And outright M&A can also be successful, where there's a similar mindset present and forms the foundation principles of the deal. Thank you.